Karthikraj, who's joining us from UTI AMC for more. Karthikraj, there was a long, expectation of a correction, a decent one, especially in mid cap, small caps. Last few months, many of your peers were talking about it, calling mid cap, small cap frothy. But finally, the last, kind of a on the camel's back was the last piece of hay on the camel's back came in from the regulator, nudging that there is definitely froth, and the market came tumbling down. You think the adjustment, the required adjustment, has already been made, or you expect some more price damage to happen before value can start emerging in the broader markets?
Yeah. Hi, Ajay. Thanks for having me on your show. So as far as the valuations are concerned, we put out this numbers on a monthly basis in our insights videos, where we've been saying for quite some time now that the mid and small caps have indeed become expensive, while large caps still are a little less expensive. So compared to their own history, whether it is mid caps or small caps, they are at least more than one standard deviation away if we take a price to book, trailing price to book as a multiple. Um, so to that extent, anyways, within the three market caps, our preference was clearly large caps. And partially with the last few days fall, some bit of that expensiveness in mid and small caps would have got covered. But still, they continue to be expensive, and still we believe that large caps may be a little more attractive on a relative basis.
So you expect that large caps from here on provide much better safety. What kind of earnings growth are we talking about, or are you expecting, Karthikraj, in the large cap universe next 2 to 3 years?
So if we look at the consensus estimates are in the teens, which is a healthy number to look at. I mean, just to take a kind of a background, I mean, in the 2010 to 20 decade, the earnings growth was in single digit. And it's only post-COVID that we've seen a very strong earnings growth. So almost if we take Nifty, doubled in almost 4 years time frame, and to that extent a CAGR of 18 odd percent. So it's come with, I mean, a healthy growth has led to the markets doing well. So it's not just that markets have run up on re-rating, but supported by good earnings growth. And good part is the cyclical and investment part of the Nifty didn't fire in the last decade, which has started to kind of contribute meaningfully in the last few years. That trend is likely to continue, and from that perspective, overall we're still looking at a double-digit earnings growth, teens kind of numbers, which is quite healthy.
To say this rally was actually backed by fundamentals. It may be giving bit of a steam and broader markets may correct, but that doesn't derail the earnings picture, at least for large cap universe. Okay, what are your thoughts on the kind of growth we are seeing? RBI in an interview just 3 days, a week back to us said the current year may grow at 8%, closer to 8%. Are you confident that this high growth could be prolonged in nature? And if yes, then India's capex cycle may actually continue, and earnings cycle?
Right. So, I mean, clearly, even Q3 numbers have been better than expectations, and to that extent, FY24 numbers may also be upgraded. FY25 again in the range of around 6.5 to kind of 7% kind of ballpark consensus numbers. If we take longer term, even in the last 10-20 years, which could kind of entail multiple cycles, we've seen around 6 odd percent real GDP growth. And on such a large base, if we are able to deliver that kind of growth in the next decade or so, that is still very good. I mean, individual years, it can be 7.5 as well, which can be quite positive. Overall, even with a 6+% kind of growth, will be one of the fastest growing amongst all major economies. So to that extent, it is going to be a commendable job, and even a 6+% growth should look quite healthy. If it is 7+, nothing like it.
I'll let you go, Karthikraj. Can you tell us about what are your top overweights right now in this market, especially the ones which provide best risk reward, because they may not have participated in the same way in the last 2-3 year rally as some others have?
One of our key overweights has been private banks. The large private banks have continued to gain share from zero, probably 3 decades back to the current levels. They've continued to gain market share. So here we have a story of companies growing faster than the industry, and the industry itself growing in line or probably faster than the economy itself, the nominal GDP. So that's where it's a high growth story. And the valuations, if we compare their own history, whether 5 years or 10 years, this is one sector where the valuations are also quite comfortable or lower compared to their own 5-10 year history. So from both from valuation perspective and growth perspective, private banks clearly stack up well. The other overweight is IT. We've been overweight on IT sector for the last year or so. Um, uh, the IT sector in 2021 was building in extreme optimism. From there, we've seen price correction and the time correction as well. Post that, the valuations have been attractive, and the longer term opportunity for these IT services companies still remains intact. And that's where we've increased the exposure, and we continue to be overweight on that. Besides that, on the consumer side, we are far more inclined towards the discretionary side, whether it is autos, whether it is durables or retail. Some of them have underperformed, like you mentioned, in the last couple of years. But these are structural stories where it is unorganized to organized, increased penetration, the per capita income going up helps some of these companies and sectors. And that's where we believe with the valuation also going through a time correction, many of them are attractive, and they should compound going forward.
All right, Karthikraj, thank you very much for joining us on the show today. With that, we'll take a break, but on the other side, a big interview lined up. We will be joined by Sanjeev Sanyal on the next generation reforms everybody's talking about, and also his thoughts on the durability of high growth which India is clocking right now.